Hello, this is Mike Swanson of Wall Street Window. I've got a very special guest and speaking with David Skarica, who runs the website addictedtoprofits.net. And I checked before we did this video, and we haven't done a video like this in 46 days now. So I thought it was time to catch up and see what your thoughts are on the stock market. Before I get to you, I'm just going to show you real quickly. Not a whole lot happened in the market today. However, this morning on CNBC, they had Tom Leon. There's a picture of him.
He's the permabull guy,
strategist guy, and he's saying that the market, hasn't done a lot the past couple months, but he claims the earnings are really good. That this is one of the best earnings seasons he's ever seen, and we're positioned for what he argues is going to be a rocket ship launch in the S&P 500 up to 2350 by the end of the year. He's saying buy right now, immediately, get ready. So that's what was on TV this morning. And I'm curious, are you as excited as Lee is about the potential to make a quick killing before the end of the year in the stock market?
I would like to know what planet he lives on, because I'm looking at earnings, and the only company I can really think that has kind of had a really big jump on earnings is Netflix. And Netflix is kind of like a 1999-2000 internet stock, in that because it has growth, what people are doing is it's measured on different metrics, where something like 3M has to make money, has to beat their earnings number. Same with McDonald's, right? These big companies. But Netflix, all they care about is the subscriber growth, right? So what happened with Netflix is they're expanding the subscribers overseas faster. And there's a big short position. The stock went up. But if you go look, at Caterpillar, at 3M, at Under Armour, and Under Armour was a growth stock. This wasn't one of these big stocks that's stalling out. At Southwest Airlines today blew up. I'm seeing all these stocks that are actually blowing up and going down 10 to 15%. On earnings, and we're talking Southwest Airlines is a big airline company. This is not some, little micro cap stock or something. This stock was down 8.5% today. CMG, Chipotle, right?
Yeah.
It was down 9% today. And this is a stock that's already off, was already off about 40% off its high going into that today. And by the way, Chipotle is a huge breakdown today. The support was at about 385 to 390. We've smashed through that today, and this is a stock that I don't even know how it's holding up. When you're talking about a $300, $400 stock that is now seeing 20% year over year sales declines because of all these problems they've had at the restaurants.
Dude, the volume is crazy on it.
Oh, Chipotle, yeah, this was a huge breakdown for the bulls on this stock, for the Jeff Mackeys. Jeff Mackey loves to trade this stock, right? So I look at these companies and I see what's happening, and I don't know, a lot of these. You can see that chart, even if you're not a chartist in Chipotle or your CMG, you can see the breakdown. You can see that support there at roughly, I said 385, but it's really about 400. It was just holding around 400. And today we smashed through it on huge volume. It probably means we're going to be heading to about $300 on CMG, right? And to me, again, it's incredible that this stock stayed with this kind of valuation so long, even though it did decline, from 700 to 400, 450. When you're talking about a stock, it doesn't even really have a PE right now because it had a couple of bad quarters and negative earnings. But when you're talking about a stock that, actually does have a PE of 53, there you go, 53 times earnings on a stock that has no growth. As the revenues are declining, 20% year over year. It's ridiculous that this stock had this kind of valuation, going on. This stock trades, Mike, by the way, at 2.5 to 3 times revenues. Again, ridiculous valuation for a stock that now has no growth. Like Amazon trades at 3 times revenues. We know Amazon is growing like crazy. Now, Amazon's still very overvalued, but there at least is there an argument there for Amazon. With something like CMG, it's just holding up. And by the way, I've seen this with all kinds of stocks here. Like I'm going to put my charts on myself here. It's the great thing about Hangouts. Let's do the entire screen, okay? So what I'm going to show you right now is we're going to go look at this is CMG is what a lot of these stocks have done with break down, which is really interesting. Like you can see Under Armour too, fell and then rallied, kind of went sideways the whole year, and now is breaking down through these lows. And you can see Under Armour was a $7 stock back in 2011. And this is a classic parabolic curve. You see it was $1.50 at the bottom of the financial crisis. All parabolic curves collapse. So Under Armour may be a great company, but I bet you ultimately when we finally do enter a bear market, Under Armour is going to go to $10 a share, So, and again, what we're seeing is a lot of these stocks, like this is Nike. Nike hasn't reported. Nike actually reports in the third month, so it won't report till December. But you can see Nike also is starting to roll over here. It has gone from 67 to about $50, $51 a share. So, and then, okay, we're also going to look at, this is a long-term chart, so I'm going to short term. This is also, this is Love, and same thing, you can see that if we go back, Love has kind of been going up and down all year and then kind of gapped down on big volume again on its earnings. So this is what I'm finding is a lot of the stocks that say have bad fundamentals or expensive and that have just kind of been in these sideward trading patterns are now starting to crack, this earnings season. Another one was Alcoa did that. You can see Alcoa, again, kind of been going sideways here and then boom, had this big move lower, on its earnings here. So we're going to have to see what happens, but I don't know what planet Tom Lee's living on. Now, the financials have had good earnings, like I'm putting up JP Morgan now. And the reason, you can see JP Morgan's actually near a new all-time high. And the reason for that being is that when the bonds sold off, the financials can then, use the difference between the short yields and the long yields. And when we had, basically right at the start of the quarter is when bonds peaked. So that gave financials more leverage on their balance sheet. So that kind of helped them right now. So the financials did have a good quarter, but again, can the financials depend on the long bond selling off 7% every quarter? Probably not. So I don't know. I just don't see what Tom Lee is seeing. Apple's earnings were very mediocre, and Apple fell, 2-3% today. So I really don't see this great earnings. He's a perma bull, so I'm going to kind of take that with a grain of salt. And by the way, if the earnings were that great, we'd be seeing upgrades, of earnings. But instead, what we're actually seeing is Goldman Sachs for the next fiscal year for 2017 downgraded their outlook for the S&P. So, that's kind of says everything right there anyhow.
Well, when I look at the article for the Tom, and one of the things about it is that I looked at the comments that people made about it, and some of the people were making fun of him, even though he is a CNBC superstar. They said kind of what you were saying, that he's always bullish, always makes a price prediction about 10% or 15% from where we are, no matter what the price of the market is. But this person saying that then said he could be right for the wrong reasons, that perhaps what's happening in the stock market is everyone's frightened by Donald Trump, or the possibility of Donald Trump becoming president. Especially people in New York City are very scared of him. They think he's going to eat them if he wins. And therefore they're not buying stocks. And if Clinton wins, which all the polls say she will, then these people that are scared will start to buy stocks again and create the type of rally that Tom Lee's predicting. So could that be the case that this message board commenter is saying?
The problem with that is when you look at the internals right now, like the advanced decline line, like the new highs and new lows, like the stocks trading over the moving averages, I'll show this in a second too. When we look at these kind of fundamentals or these kind of technical indicators, they're not showing that. They're showing actually the internals are really weak on the market again, setting up similar to what happened last year when we saw a sell-off. So what's gone on is, in my opinion, is I don't know. I actually think if the market was really scared of Trump, it'd be selling off right now. You know, you might see the Dow at 17,000. I think it's the exact opposite. The betting sites are saying there's an 85% that Hillary wins, okay? So if there's an 85% that Hillary wins, I'm just going to show you this right now, some of the sentiment indicators here. Well, then wouldn't that tell you that the market is already priced in her winning? And I think, you know, it's not like the Dow has had some huge sell-off. It's at 18,200. The high is 18,600. It's 2% from the high. So I think kind of the opposite, that what we're setting up for right now is for the market to kind of roll over no matter who wins the presidency. And I think that could happen after this earnings season, because here's an interesting thing. So here's some of the indicators here. This is as of yesterday, because it's about 4:15, and they don't update these till 5 or 6 o'clock. But you can see this is new highs to new lows. You know what we were in the summer after the Brexit vote, even this spring, you know, when we had the rally. Now we only have 10 new highs and 5 new lows. That's actually usually what we're seeing when we're starting declines. You know, you can kind of see actually similar numbers in December here before we started a big sell-off, you know, that the new highs really kind of taper off. And this is the RIDEX ratio, which is a ratio of where people are actually putting their money in bull and bear funds. You can see it's 0.25, which means there's 4 times as much asset and bull funds as there are bear and neutral funds. And again, you can see if you go back to kind of this big top over the first half of 2015 and last quarter, that's kind of the same area we were in. So I'm thinking that either you sell the news if Hillary wins, or you really see a larger decline if Trump wins over fear of him being the Antichrist or something, you know? So, but I think a major factor in what's going on, and the one the market hasn't done anything, is if you remember last earnings season, and see the problem with these guys is they don't take these kind of things into account, is that this is a stock, this is 3M. And we can see last year 3M, you know, had this rally, declined again here. But see this rally, this was about when its earnings were last year. I remember 3M specifically announced a big buyback in the fourth quarter, okay? I remember J&J announced that they were going to be borrowing money to buy back stock. And look what happened to J&J after then. The stock went from 90 to 125. All of these stocks now, I can't think of one company right now that is announcing a big extension or addition to a stock buyback. And ETFs are seeing outflows. Foreign investors are outflowing stocks or selling stocks. Mutual funds are seeing outflows. The only inflow into stocks right now are companies buying back their own stock. And that in the third quarter really slowed down. So if this slows down even further, then that means I really think there's limited upside to this stock market here. And then what's happened is there's been sector rotation in the stock market. The semiconductors have been hot for a few months. You know, there's been a lot of merger and acquisitions in that sector. Okay. And then, you know, we just saw this big AT&T Time Warner deal. So a lot of sectors or companies have gone higher because we have seen M&A and we saw a bounce in oil and gas, which helped that sector. So you've seen a bit of this rotation. One sector's been weak, another sector has come in. But, you know, judging by the new highs, judging by the stock, one thing I didn't show in that, I'll go back to that in a second. There's another good technical indicator I like, and that's the stocks trading over their moving averages. And, oh, sorry, guys, it's up, sorry. Yeah, stocks over the 20, 50, and 200-day moving average. And you can see that right now, only 39% of stocks are over the 20-day, only 38% over the 50-day, and over 59% on, their 200-day. And again, notice when we talked in 2015, and then on the rally in late 2015, the similarity where these indicators, the stocks over the moving averages, were trending down in each case, and then that led to the smash in the market. And again, if we kind of look, what's interesting is that this kind of 2000 to 2050 area on these last declines, when that broke, the market just kind of fell off a cliff. So, okay, we've got some wiggle room now. We're only at 2140. But if we slowly kind of move down to 2050, 2025, then I think the S&P can kind of go. And if you go look at a much longer term chart of the S&P, which I'm going to show right now, let's show a 10-year chart, you can see that if we kind of break down, and this was similar to kind of like when the S&P broke about 1,400 back in 2008. If we break this 1,800 here, that we're probably headed a lot lower, and that will really begin the bear market.
Right. Well, I'm going to bring up something really simple. Here. And that's just what's going on right now is I've circled, this is the S&P 500, and I've got two circles on it. One is right now, but the other one is the last earnings season when it took place. And the market only went up for 2 days at the beginning of that earnings season, then basically did absolutely nothing. That was in July. Averages would go up one day, then go down the next day. And then in August, there was a breakout that went absolutely nowhere for a few days as the market just did absolutely nothing in August. And, of course, it fell for like 2 days in September. But the most wild thing about the stock market is how it seems to be doing nothing. No sustainable moves. Those lines around the price candlestick chart there, those are the 20-day Bollinger Bands. They got so narrow in September that they were so close together for so long, for such a long period of time. And I'd never seen it before like that. And you had to go back to 1993 in August, and then you have to go back to the 1970s for it to continue after a month like that as it's doing now. So to me, this is the most noteworthy thing about the stock market action. The internals are slowly dropping, and the new highs are bad, as you were pointing out. But as far as the market averages go, it really seems like nothing's going on. When Labor Day came, the volume didn't even really pick up. Usually it does. It's trading as if it's still July. And I'm just wondering, what do you think is the cause of that? And how do you make money in something like that?
Oh, so what do I think the cause is? I think like there's a lot of reasons for kind of the suppression of volatility. I think one reason is just quite simply interest rates. It's the whole thing I just talked about, earnings. Let's look at McDonald's. Okay. McDonald's did have a sell-off and then it rallied a bit in its last earnings, but this stock is a stock that's had revenues declining for really 2 or 3 years. And why has the stock been able to go from 85 to 110, even if it's off from 130? Well, it's because McDonald's yields 3%. So people are saying, well, I'll own McDonald's, I'll own 3M, I'll own these companies that own 3% because that yield 3% because the 10-year bond is 1.8%. So I'm getting an extra percent a year from McDonald's, and McDonald's is a well-known blue chip company. So I think what happens too is these low yields can suppress volatility. And then I think that we talk about these hedge fund robots a lot. They really dominate the day-to-day trading now in the market. Retail investors, even institutional investors, are not there like they used to be. So what you could see, I think, with a stock like Chipotle, and the reason it held up, really Chipotle held up between 400 and 450 almost the whole year, despite the fact that its fundamentals are complete garbage. And I think it was because the robots probably had an algorithm program that were in there buying it at 400, off 400, off 400. So I think you get this combination of the hedge fund robots dominate the trading day to day, and they're buying at support levels, they're buying at moving averages. And then combine that with the fact that low rates can kind of suppress volatility shorter term. And then I think also it's because the central banks are being proactive. If you remember what happened during both the Brexit, both the Brexit both the Brexit, and the earlier sell-off, which had to do a lot of problems in China. Well, let's think about what happened here, Mike, okay? What happened here in each case was, after the Brexit, the Bank of England cut rates and started printing money, okay? So you had this little blip down and the markets all moved higher. During this first quarter decline, the ECB increased quantitative easing. Japan went negative interest rates. The Fed began to talk a lot more dovishly, like they wouldn't raise rates basically to the end of the year, which now it looks like is going to be the case. And then in China, they loosened the purse strings and kind of inflated real estate bubbles again and let lending go again. So I think there's this belief now that whenever things get a little shaky, the central banks will come to the rescue, and that also suppresses volatility. So, and it just seems like ever since the 2000s top, that's kind of been the nature of this market. We get these these tight trading ranges, and then these big sell-offs, and then these rallies back, and then these tight trading ranges again. Yeah. And that probably still has to do, in my opinion, when it all comes down to it, with the robots, buybacks. It's just really people still have faith that the central banks can prop everything up. And the question is, when do they lose that faith? And when they lose that faith, that's when you really see everything kind of roll over to the downside. And I've told you many times in private, just to end off here, my feeling is something big has to happen to really break the market. Now, you can still make money shorting stocks. I just showed you, Love. I just showed you CMG. I just showed you some of these companies that have really rolled over. Actually, one of the shorts that I've kept for over a year in my letter is Skechers, which has gone from 54 to 20, But I think that and we shorted this, by the way, at roughly 50. It's not like I got in early and got killed, but so what I'm saying is, I think until you get Deutsche Bank blowing up, or China has to devalue their currency, or maybe a big emerging market like Turkey has a debt or currency crisis, whatever it may be, something big has to happen, because that kind of creates a liquidation and almost like a big margin call for the whole market, where the central banks can't just step in and come to the rescue. And who knows, if Trump is elected, well, they might be less inclined to come to the rescue, because they may say they're not politically motivated. We all know they are. And if Trump wins, well, why do they really care if the market goes down for a little while? Because they really have no affiliation or loyalty to him.
Well, they might simply want to teach him a lesson of how important they are and how he must obey them, or they'll let the market keep falling. That may sound kind of crazy, but if you go back and look at history, that's what the guy who is head of the bank, I think it was called the Bank of the United States. There wasn't a Federal Reserve before the Civil War. There was a Bank of the United States, and the guy that was in charge of it told Andrew Jackson that he was going to wreck the whole economy and force bankers to call in their loans if he tried to get rid of his bank. And he did just that, threw the whole economy into recession. Not that something like that's going to happen, but they may just want to signal to Trump that, look, you better not talk mean about Janet Yellen or any of the others, or else we won't, play nice. You better play nice of us, and we'll play nice of you, so to speak.
Yeah, and of course he's been very critical of them. And, with some of the things he's talked about wanting to do it with interest rates with infrastructure spending, I don't think he is going to be against zero interest rates. He's going to help, if he really does want to increase military spending. We both know that Trump is not a libertarian. He's not really a small government guy. So he's going to want to spend, and he's going to need interest rates to stay low and suppressed to spend, on a certain thing he wants to spend on. So I don't think he's going to be totally anti, what they're doing. I just think it's like Jeremy Corbyn, who is the Labour leader in Britain. He has said that he wants to do QE for the people, saying that instead of QE going into financial markets, going into stock buybacks, going into increased asset prices, increased prices of real estate in the city of London, in London. What he wants to happen is it to go into infrastructure, to go into roads, to go into schools, like basically monetizing the government debt to do these social expenditures. And I think Trump will be more along those lines if they do another round of QE. He's going to say, okay, we can do this, but I want to build roads and airports and do military spending and that sort of thing, and not just help these guys on Wall Street or whatever. I think that's going to kind of be the plan. But yeah, but again, in the short term, if he wins and it triggers a stock market sell-off, and I think it's different from the UK, because the difference is in the UK, the problem was in the currency, right? We've seen the pound have a big move down since the Brexit vote. And if you look at this move, you can see the pound was already moving lower, but if you look at this here over the first half of the year, I think the pound was ignoring the risks of the Brexit and then had to readjust when it occurred. And I think, but in the US, it's not the currency. I think it's the stock market in the US. I think it's the stock market is ignoring the political risks of a Trump presidency. And look at, I'm not even really pro-Trump or anti-Trump. If you wanted my honest opinion, I prefer him to Clinton, because I think Clinton's a complete nutcase, But what I'm saying is, because of his policies on trade and the kind of jingoist talk that he has, jingoistic talk, I think that there's a lot of uncertainty, and foreign investors might not like it, and probably the stock market has not actually discounted it. And I'm not a conspiracy theorist type guy, but I would actually say the opposite of what that you told me that poster in Yahoo Finance said, that I would think that the market's actually being propped up or kept up to kind of like the pound, and to keep this belief, to basically show that, hey, the markets don't care, Clinton's going to win, rather than, the market's going to take off after Clinton wins, Because one thing that Clinton will not be good for is the biotech stocks, which have acted very poorly anyhow. And because, she's on record, and who knows, because, quote unquote, she has a public position and a private position, but she has talked about cracking down a lot on drug price increases and all this sort of thing. So, that's been a huge driver of this stock market bubble, has been the biotechs, and probably Clinton winning will not be that good, for them, going forward.
Yeah, probably not. Well, when it comes to the market, as you pointed out earlier, with the internal indicators, I'm just pulling up the percentage of stocks above the 200-day moving average for the S&P 500. Those internal indicators are slowly going down. And to me, if that happens and the stock market, remains about where it is, that will be a warning that at some point there will be a pretty sharp correction. My guess is we'll have some sort of pullback after the election, or perhaps into it sometime before Thanksgiving, and then a bounce into New Year's. But if the internals remain sloppy, I think that we'd be set up then for a decline like we saw this past January. Pretty sharp, pretty fast, pretty intense. Maybe the central banks, talk some stuff to make things bounce after such a decline. As you said, they seem to like to step in to stop things from getting out of control. So to me, that's where things are headed. However, on the flip side of that, the bullish case. I get lots of emails from people who, we're all seeing the stock market just float around. It doesn't really seem to drop. It's been like this for the past couple months, and people say, well, the Fed is in control. The Fed won't let it drop, and this and that. However, one thing I think we should point out is that despite the stock market not dropping, it's not going up either. There has been no move to 2,300. I mentioned August when the Bollinger Bands are super, super tight. The reason I knew it was like that in 1993 in August is because I read an article by CNBC market superstar Santoli, who said this is how the market was in 1993, and he predicted a massive rally would happen in September. It didn't, obviously. And that's what seems to happen is the bulls are predicting rallies that don't happen. The crashes don't happen. The market just floats around. Nothing's really happening. And I think the Federal Reserve, yes, they may not want the stock market to go into a bear market, and it could be that the bear market doesn't start until they lose control or something really bad happens. But also it seems at this point with the stock market valuations where they're at, that the Federal Reserve doesn't really want to see the stock market go up in a dramatic manner either. People say it's going to be a blast off like 1999 before it tops. They've been saying that for 2 years. A blast off has never happened. I don't think the Fed wants a blast off like that to happen. The Fed, I think, at this point doesn't really care about the stock market. They just want it to stay where it is, let the corporations use it to raise money, to do buybacks, to do whatever they want, but they don't want a repeat of 1999. They also don't want repeat of 2008. They are just, I think, hoping the stock market can sit here and float forever until finally one day there is a real economic growth in the economy that does create real earnings growth, and the earnings can catch up with the stock prices. Whether that, something like that could take years though to happen, and it seems to me to be very unrealistic. There's economists out there that say that any GDP growth over 4% nowadays is really unrealistic. It's not going to happen, and even if that's required to make the dream scenario to fix the stock market valuations take place. So I think we're sort of in this limbo land. And again, I'll ask you that, I think a lot of people are kind of in a desperate times to try to do something to make money because the market's not going up the way they want. Most hedge funds are only up about 3% year to date. They're lagging the market badly, that 3% when you take out their fees, by the way. So they need to do something. They need to chase something. They need to try to make money. I'm seeing people on Twitter trying to guess bottoms in various sectors, such as biotech, hoping that they'll bounce and turn around like a desperate play. Others are, going. I tried to go on margin August to find a way to make money and pare that back. Others are using triple ETFs. Gold dust traders, JNUG traders, nugget traders. People are trying to increase their risks to try to create some sort of positive movement in their brokerage accounts in what is a dead stock market. So is there any safe way for people to make money, something simple that people can do besides what seem to me to be very desperate gambles?
Well, the easiest thing for people to do, and this isn't exactly sell newsletters, is, to be honest, is just stay in cash. For the average person, other than maybe owning some precious metal stocks, because right now they're still cheap, is that really you're looking at, the market at record high valuations of price to sales, stock market cap to GDP. And actually a great philosophy in the last 20 years, since the late 90s, has been that all you do is you wait for these busts to happen, and then you just buy the bust. And if you find a couple of good stocks that are even more leveraged to the markets on a bust, you buy them. And instead, when the market rallies whatever 50 or 100% or 200%, and 5, 6, 7 years, these kind of stocks can go up 500 or even 1,000%. So just stay in cash. Wait right now for a big downturn. Like I kept putting it off, but I actually have an issue I'm going to do on stocks that I want to buy when there is a bust. And the reason I kept putting off is because, there hasn't been the bust starting yet. So, but so like, if you have kind of a laundry list or a Christmas list or whatever it is of what you want to buy, just wait, because it's probably going to get cheaper outside of that. And then I think you look at, again, the gold and precious metal stocks. I don't know if gold is going to bottom this month or next month, but probably in the next 6 months, gold will complete this kind of bottoming formation, and you're going to want to, be in that. And I agree with you 100% with what you just said on the stock market. If we look at the S&P here, you can see that since 2014, the S&P has done virtually nothing. That, it was, you can see at the end of 2014, over like 2093 here at the top in December of 2014. So in almost 3 years, the S&P is up 40 points. That's 2% in 2 years. That's 1% a year, including the dividend, which is about 2%. You're making 3% a year. That's nothing. It's barely even keeping up with inflation. So we can see that the stock market is really doing nothing. And when I laugh at these people that, the S&P is going to 2,300. You want to put all this risk so you can make 6 or 7 or 8%. When the S&P, it's either going to go to 2,300 or 1,300. So you're going to lose 40%, but you can make 7%. That is not good risk reward. So let me just show you an example of what I'm talking about in terms of waiting. One of the stocks that I'm short right now, and we shorted it a couple years ago and then re-shorted it this year. This is Sotheby's. Now, Sotheby's is the auction company. This is a boom and bust stock because, this auctions obviously are for rich individuals and all this sort of thing. And what we can see in every bear market, Sotheby's in 1990 went to 4, in 2002 went to 5, went to 5 again in 2008. And then it goes back up into the 30s and 40s during the booms. So this is a stock you can be shorted if you want to make a little bit of money if you think we're going to enter a bear market. Or you could just wait, and if there's another bear market, it's probably going to go to 5. You can buy it 5, and it's going to go back probably to 25 or 30 or 40 after that, right? So this is the kind of thing that you could wait for and trade. And another thing that I'm doing in my newsletter, and this isn't for everyone, but I have a select amount of subscribers doing it, is I'm buying these little junior mining stocks. And the reason being is they tend to move a little later in the cycle. And most of them are just sitting there right now. And you can see this is the CDNX, which is the junior mining or the junior index in Canada. And what we can see here is this was the last 2 bear markets in it. Like you see here, and then bull markets. This is a big bull market. It went from 800 to 3,300. Then it crashed during the financial crisis, then went back here. So what I'm doing is, you can see we're actually only back to where we were roughly at the 2008 low. So what I'm doing is I'm kind of starting to buy financings in the stocks, which come with warrants, which give you, the right to purchase more stock. And my feeling is this was such a long bear market. We don't have this index going because it only started in 1999, going back to when the juniors had a 4-year bear market from 96 to 2000. But we can see when they went down from 96 to 2000, they almost went up for 6 or 7 years. So I'm spending the next little while kind of averaging into some of these deals, getting the warrants, which give me a right to purchase more stock at a cheap level. And then if we're right and the junior gold miners take off and silver miners take off in the next 2 to 3 years, I'm going to be sitting with all these stock in these companies and the warrants, which I can exercise,
Yeah, I'm going to show people an example of what you're talking about.
Well, I'm going to show just, okay, Mike, just before you do that, I'm going to show, this is an example. I don't mind giving one of the companies that we have.
Go ahead.
And this is Meadow Bay. Now, we bought this at a financing.
We both own that.
We both own that. And we bought this in a financing at 6 cents And right now it's 7 cents. So even with the stock doing nothing, we're actually up 16%. And you see there was a little spike here, but what I'm saying is Meadow Bay is just kind of having this basing going on here. And that's kind of what a lot of these juniors are doing. That, you know, it's just kind of, I'm getting a shorter term chart. Yeah, you can see it's kind of been going sideways. You know, there's a little break here, but really it's between 6 and 9 or 10 to 10 cents the whole year. So that's what I expect a lot of these juniors continue doing, say, for the next 6 months or even maybe next year. But then at some point, because these are small cap companies, they don't have a lot of overhead. They're, and they usually move in the second phase of the gold bull market. I really expect them to take off. And again, it kind of coincides with my feeling on the stock market, just my final point here. And my feeling on the stock market is what we've been talking about, or the American stock market is, we're not going to see a big move in gold and precious metals until this bust happens, because we've seen a nice move off the lows, but what we really need to drive the next move in commodities and the next move in gold and precious metals is we need that bust. So the Federal Reserve comes in with QE and zero rates or negative rates or whatever they do to kind of give a gold that second boost. And just to finish off with that note here, that's essentially what happened in, I'm going to show you the HUI, which is the gold index, the major gold index. And we're going to go back to 2000. And what happened here, this was the move off the low, okay? And the Fed actually started cutting interest rates in 2001, 2002. So the first few months, the Fed hadn't done anything when this bottomed. But then finally, when they did, it really took off. And then in 2008, it was the same thing, that when they started doing their they were cutting rates, this whole move down. But when they started doing the QE and that sort of thing, it really pumped it. So in each of the last two bear markets, the gold stocks kind of did nothing, as the Federal Reserve wasn't really, dovish. And then all of a sudden, during the bear market, when the Federal Reserve began to do QE or cut rates to almost zero, the gold stocks really took off. So that's kind of what I see playing out here. And it's probably similar to where we were in early 2009, early 2000, where we've seen this nice move off the bottom and we might consolidate. You can see in 2001, it's consolidated for like 6 months, and it consolidated in early 2009 for 3 or 4 months. So we can see that might have started this consolidation, which could last into the end of the year, early next year, and then really take off if, we again see the central bank kind of take a dovish tone, which I feel they will do by the end of next year. I don't believe they're going to get away with what you just talked about. Oh, let's keep the stock market up, and, even if it doesn't go up a lot, the economy can grow into it. I don't think that's going to happen. I think we're going to have some kind of bear market or crisis before that occurs.
Well, if we're just looking at your HUI chart, you're right. It feels like the gold stocks are where they were in 2000. We had the big rally off the bottom, to end that last bear market, because that bear market was huge. And you typically, when you get a huge bear market, the next bull market starts off with the 100% move or even bigger off the bottom. That's what we got. And then you get a sideways period. So it seems exactly like that 2001 sideways period. What I like to add to that, though, is that with the mining stocks, typically in the first part or the first leg of a bull market, the big cap stocks really take off, the Newmonts, the Barricks in particular. And the small cap stocks, the junior stocks, more speculative ones, they tend to just recover off the bottom, but not really, go crazy or anything. But then on that second leg up, when it starts, they tend to really start to take off and go up quite a bit. So that's why, one thing about, you showed the Meadow Bay, I would just use that one as an example. One thing about it is we both bought that in a private placement, which gives us warrants attached to them as a free bonus. What the warrants are long-term options that go out for a couple of years to buy more shares. So if the stock goes up, doubles or triples or whatever the case is, we've got warrants to buy them at depressed prices at where they are essentially just where it is almost exactly right here. So
Yeah.
free long-term options for free. It's awesome. And that's a good way to make a lot of money on these things.
And
But
another thing too is these things
yeah,
have 4-month holds. So even if, say, you got tired of waiting for Metal Bay to go higher, and we don't want people just dumping all their stock in these things, but if you got tired of Metal Bay going higher and you sold it here, you could keep the warrant, and the warrant in Metal Bay is 7 cents. So even if the stock went to 20 cents, you could go exercise the warrant at 7 cents,
yeah,
and then be able to sell that stock at 20 cents or 30 cents or whatever. So, and like I said, or if you keep your stock, whatever the case may be. But what's great about it either way is Meadow Bay could go to $1 and you'll be able to buy additional stock at 7 cents. And this is, by the way, how all the insider guys in the mining industry, the guys you read about, the Robert Friedlands, Stan Barty, anybody who's made a lot of money in the junior mining market, this is how they make their money. They do these financings. Now they're setting up their own companies this way, but they're taking down a lot of their own company stock, but then they have that warrant, and if their company gets taken over, well, they've got all these warrants they can exercise, and the company's taken over at a much higher price, or the company has good drill results or puts a mine in production, whatever the case may be. This warrant gives them basically a way to almost double their position, So, let me give you the basic math on it. If Meadow Bay went to 50 cents, that's a big move, I know, but let's say it went to 50 cents. Say you had 100,000 shares with 100,000 warrants. Well, your 100,000 shares, are worth $6,000. That was the financing. At 7 cents, you'll spend another $7,000 to exercise that warrant. Then all of a sudden you've got 200,000 shares. You've spent, $13,000 on, and the stock at 50 cents is worth $100,000 instead of just, or 200. So is worth $100,000. So instead of just $6,000, if you bought it in the market going to 50,000, you got 13,000 going to 100,000. Your profit is 87,000 instead of 44,000. Right? Almost double the profit. So that's kind of how it can work out in your favor,
Well, both of us have bought several financings this year, and we told our subscribers about them and some of them got in them. And I'm just curious, with your service and what you're doing, are you planning on doing more before the year's over yourself?
Yeah, I actually got one I'm going to do, but it's not a gold deal because I've been doing all gold deals. So the one I'm probably going to do within the next 3 weeks, but it's a great deal. And it's actually a deal that I think can do really well. It's a lottery deal.
Okay.
And that's a great, recession-proof kind of business, right? It's basically with this deal, what you can do is it's an IPO, so we'll start trading in January. But what you'll be able to do is, with their technologies, it's really simple. It's just like you have an account, a monthly account. Like I have a monthly account here on Stock Charts, right? What you do with them is you have a monthly account, and you can just buy lottery tickets online, which, if you have one of these Powerballs, is a great thing. You don't have to go to the local grocery store and wait a half an hour to buy a lottery thing. And we all know in a recession, when people don't have jobs, they're going to buy lottery tickets, right? So this deal is that. But yeah, probably by the end of the year, and right now we're talking it's late October, I'll probably do one more gold deal by the end of the year. So if people are interested kind of in that. And what I really want to do is, at some point, I'd like to do about one a month. I put it off now because, I predicted in my newsletter, by the way, that seasonally we would see a pullback in gold and precious metals into the fall, and that's what we see. And the HUI has gone from about 270 to 210. So I think that this kind of pullback and consolidation can continue to the end of the year. And I'll show you why in a second. But I think as that pullback and consolidation continues, I'll want to kind of add to more of these bottom round kind of gold deals. And the last thing I'd like to note here is I think something that people really have to watch is the U.S. dollar. The U.S. dollar looks like similar to 2013-14. and might have completed this big consolidation and might run to new highs. Now, people might think that means the U.S. is doing great. No, the U.S. dollar is a function of global liquidity. Usually the U.S. dollar is weak when the global economy is doing well and the emerging markets are outperforming and the whatnot. And the U.S. dollar is strong when you're getting, bad markets, bad debts, et cetera, et cetera. So if, we can see the U.S. dollar was strong during the 2000 to 2002 bear market. We can see the U.S. dollar was strong during the 2008, 2009 bear market. We can see it was strong during this correction here in 2010. So I think that if we break this high and go to 110 or something on the U.S. dollar index, that would be a sign of severe problems in global liquidity. Now, the only thing that maybe prevents this is if you go look here in 2008 to 2010, there was a triple top, and there was a triple top here in 2001, 2002. So the question is, are we seeing just another triple top, or are we going to break higher in the U.S. dollar and see another kind of liquidity crunch? And obviously, if we see a liquidity crunch, commodities will probably have one leg down, and and the whatnot. So, and that could, I don't think gold will be too hit, even if the dollar goes up. And the reason being, we see gold hasn't been hugely hit at the dollar going up as of late, because gold is going to be more a flight to safety in that regards. Like gold went up in this 2001-2 period while the dollar was strong. So I don't think gold will be hit that hard, but that's one thing to watch here going forward. And one reason, well, I don't think gold will be hard hit, if we get another big pop in the US dollar, I think that could hold back the gold prices in the short to intermediate term, in the short term,
Well, before we did the video talk, and I got you to agree to do a special offer to get people into your service. It'll be up till Thursday night. So could you, if they do that, they'll get, of course, these ideas that you have already mentioned. But can you explain what people will get if they join?
Well, I'll tell you, like, one idea right now is one thing. Remember I mentioned Skechers?
Yeah.
This is the kind of thing we do, too, if you're just a trader. We did a straddle trade on Skechers where, like, this stock you can see has these big moves. It's had a lot of gap up here when it was topping out, and then a lot of gap downs, even a lot of big moves higher during this downtrend. So what I did is a straddle where I bought 25 calls, January 25 calls, and January 21 puts, right? And the idea was that there's a big move, they would happen. And the day that Skechers gapped down on its earnings, the calls obviously tanked, but the puts went up 100. Actually, I think went up, like 200, like almost tripled in a day, and made up for the decrease in the calls. I think actually they went up 150% in a day. So I think when I worked it out, the day that Skechers gapped down, we made about 10 to 20% on the trade. So I got another stock. So this is key because you said that we're doing this offer on Thursday. This stock reports Thursday after the bell, and I've got a similar trade on where this stock, I've got some calls. I'm more to the put side on this stock because I think it has more downside than upside. But I think that we're going to get a big move in this stock from now to the end of the year, because notice how Skechers was in this big trading range and then had a big move lower. Went from 32 to 18, went 40% lower. The current stock I'm looking at has had a similar trading range since about March, and I think that it's going to have a big move either above or below that trading range. So if you sign up Thursday, you'll still be able to make this trade in this company because they report Thursday after the bell. And I think obviously the earnings will be the launching pad for that big move either way. So that's kind of what we do on top of these junior mining stocks and mining stocks and whatnot. So, but again, I'd have to be adamant that Mike saying Thursday evening or Thursday at midnight this is going to expire. You're going to have to sign up before Thursday at 4 p.m. Write me an email, and I'll give you the trade and the stock that I'm talking about.
Oh, that's great. People can get started instantly then.
Yeah.
Well, thanks for taking the time to talk with me and everyone else. Unless you got something else to add, I'll let you take off. I know you're busy.
No, yeah. That's really it. Just just one more thing, because we are talking about the market. The Dow was up 30 today. The Nasdaq was down 30, but I really think the market wants to break this 18,000.
Yeah.
And we actually, what you said at the beginning, has been 46 days since we did a podcast. Well, that's roughly here after the Dow had this big bust. And I never thought when we did that podcast 46 days ago that we would still be in this 18,000 to 18,300 range. So I really think that it wants to break this range. And when it does, we'll quickly can go back down to the 200 or, 150-day moving average. And then if we break that, we can probably actually quickly go down, to the lows of earlier this year and last summer. So that's another key aspect to watch here. And again, one aspect of my service is I got a shorting service. I have a whole bunch of put options in the service. So if you are someone who's leaning to the bearish side or wants to hedge with shorts or puts, I can probably give you some ideas. And I mentioned Skechers. Another short that we've had recently that really kind of busted. This is this, excuse my language, this bullshit beverage company called Fizz. And it looks like they might have some accounting problems. But anyhow, this stock has gone from north of 60 to as low as 40. It's now in the mid to late 40s. So this stock has started to bust in the last few months too. So these are the kind of things that, I'm not giving just ideas on like, go short Amazon. I'm giving kind of these second tier companies that I think can really fall.
Yeah, and they fall more when they get hit.
Yeah.
And Amazon may not fall for a while,
Yeah. Well, those companies are more susceptible to being maybe scams or frauds. Like actually, I keep saying one last thing, but this is really the last thing. This is a perfect example. This was a stock. I actually got out of it too early, and I think this actually might be an accounting fraud. This is Concordia Healthcare, kind of a similar model to Valiant. It's a Canadian company like Valiant, and they were just doing a whole bunch of takeovers, new drugs, doing things to keep inflating their earnings. And I actually shorted this at $100 last year. We covered it 40. The stock, you can see, is down to 5. So again, that's what happens when you kind of short these second tier companies. That's what you can really see. Yeah,
definitely. Well, thanks for talking with me, and we'll do this soon in a couple of weeks, or hopefully not in 45 days.
And hopefully the markets move more than 2% each way the next 45 days.